Before we get into this special deal review episode, here are the required disclaimers that remind you that all investments carry risk and that none of this commentary is intended to be financial, tax, or legal advice. This program is intended to display how experienced LPs analyze a deal and question a sponsor. Now let's get to it. Hello, passive investors. Welcome to our exclusive deal review webinar. I'm your host, Jim Pfeifer. Our goal is to equip you with the tools and insights to confidently step into passive real estate investing as a limited partner. One of the best ways to do that is by reviewing deal after deal after deal, so you understand what separates a great investment from maybe a not so great one. This episode, we've invited Daniel Brereton and Marious Sjulsen from Equity Multiple to present one of their latest deals. And joining me on the panel are experienced LPs Paul Shannon and Chris Lopez. Here's a review of the format. Daniel and Marious will have 10 to 15 minutes to present a basic overview of the Ascent Income Fund presented by Equity Multiple. If you're looking for more info, you can check out their deal profile on the PassivePockets website. Next, we'll have about 15 minutes to pose questions to Equity Multiple and learn more about the deal. Then we'll let Daniel and Marious go, and our panel will discuss the deal amongst ourselves. As a reminder, this is called passive investing, but your work begins with evaluating all of the underlying documents and information. This webinar is intended to augment that and help you figure out how to analyze a deal and question a sponsor. Let's get to it. Daniel and Marious, thanks for coming on our deal review series. We'll now turn it over to you for the 10-minute or so deal overview.
All right. Well, I appreciate you having us, Jim. And, Marious and I are really excited to go over a little bit about Equity Multiple, a little bit about the Ascent Income Fund, which I think is probably a really attractive type of fund right now in the current real estate environment and what people are looking for. But before we get into all that, maybe I just give a quick little overview. Marious and I, with Equity Multiple, we're a company platform for self-directed investors to get access to commercial real estate. Marious is one of our co-founders, and he's also our CIO. So he's picking the investments. He's on our investment committee. I'm on the investor side, so you might speak with me if you've called into Equity Multiple before. And I like to have conversations with investors to discuss different investments for the platform. For us today, we'd just like to give a little bit overview of Equity Multiple, talk about the macro environment, where we're seeing this type of fund fit in, and give a little bit of a deep dive to the fund as well. Then hopefully we can have some good questions and answers with you guys and get grilled a bit on the fund. Equity Multiple, modern real estate investing is what we're all about. We're founded just about 10 years ago by Marious here and Charles Clinton. Marious on the deal side, with a deep experience in all sorts of real estate, capital markets, debt, equity, preferred, everything as it comes to real estate. And Charles was a private funds lawyer at Simpson Thacher, and he and Marious got together to create a platform for investors to get access to commercial real estate. So really exciting opportunity. We've been doing it for almost a decade now, and I think, are seeing a lot more investor interest in getting access to opportunities that they might not have been had access to previously. We're seeing a lot more investor interest, especially in this current market cycle. I'll pass it over to Marious, maybe to give a quick intro to himself, and then he can tee up to discuss a bit more about the macro environment too.
Very excited to be here. Thank you guys for having us on, and excited to share some more about the Ascent Fund, with you guys, and take any questions about it. I started Equity Multiple about 10 years ago, and initially when we started, we were doing small syndications, small marketplace investments for investors, and that quickly accelerated into larger preferred equity, LP equity investments into transactions themselves, where we have negative control rights. What I mean by that is we have say so over major events, either a refinance, sale, an annual budget, anything that could affect the capital stack or our LPs. Since we founded the company, we've processed over 800 million of equity into over 200 plus transactions. And those transactions range anywhere from multifamily, small balance multifamily, to large scale office investments, and even through to more esoteric investments like car washes. When we started the company, the goal was to provide investors access to this alternative investment class, where it wasn't just for private equity funds or extremely high net worth individuals that were putting in $250,000 plus, but we broke them down into $5,000, $10,000, $15,000 investments. we were on the trajectory of doing a lot of equity through our platform. In the midst of it, we had done a fair bit of preferred equity and debt participations on the platform itself to investors. However, in the wake of the interest rate spike in post-COVID in 2022, 2023, what we found is that the opportunity for equity investments had diminished greatly and credit markets were frozen. So we pivoted into structuring an open-ended debt fund for investors, which we felt was going to be the most appropriate vehicle for investors to invest. It gives us a shelf-stable product, investors to allow them to invest in a diversified pool of middle market investments across the platform. And the goal of the Ascent Debt Fund is, most funds today are, closed-ended funds that are consist of anywhere from 5 to 10 assets with committed capital. Our goal is to create a fully diversified pool of assets that span 35 to 40 assets, all in the $5 to $20 million space. And we believe that will provide the best sort of protection against any, sort of exogenous risks. No one loan will impact the fund too dramatically. That's been our goal since we started the company is, provide investors with an ability to diversify across a wide swath of investment types, investment operators, and geographies.
Yeah, and I think that tees it right up, as Marious is talking about, the macroeconomic events that led to the creation of the fund. Maybe we can start talking about a bit more of the macro environment right now and really why we see it as supportive of commercial real estate, private credit, the senior lending that we're doing, and why it really makes it a great opportunity for us to find attractive loans and price them very lucratively for us in the fund.
Daniel mentioned the fact that the macro environment today. I think that post COVID, when interest rates went basically down to zero, it really was an attractive time to be doing equity, largely because interest, the cost to borrow capital was so low. What we wanted to provide investors was a platform to allow investors to invest up and down the capital stack. As interest rates went up, they were able to invest in a product that benefited from a higher interest rate environment. And as interest rates sort of went down, to invest in equity deals that were priced appropriately with appropriate risk-adjusted returns. What we found is that the macro environment today, it does feel that rates are stabilizing. I wouldn't say that they've fully stabilized, but what we've seen is rates are going to sort of stay at this level. The Fed's held rates steady today for longer. And I think that that's going to be the new normal for quite a while, especially through 2025. We don't expect any, rate reductions through 2025. And we still feel that by investing into the fund and delivering a targeted 11 to 13% return for 65% LTV credit, it's a great risk-adjusted return across a diversified set of loans. This is still in the wake of a lot of regional banks being frozen right now. So increased regulatory constraints around just bigger banks and how they're to lend. There has been a shift towards private lending groups such as ourselves.
Precisely. Yeah. And, I've got a couple of things, with the CRE wall that we might have heard, there's a lot of CRE loans coming to maturity. What we've seen as well is borrowers or sponsors that were potentially going to refinance. We're waiting for Fed signals and waiting for rates to keep coming down. And although rates have come down somewhat, there's still this wall of maturities that people have been putting off. So now there's sort of a lot of people rushing for the one refinance opportunity, and that's where we're seeing a lot of volume. And that increased volume, that increased competition allows us to be very choosy when it comes to the types of mortgages that we want to refinance. And we'll get into a little bit more of the mechanics of the fund later, but we have the ability to choose low LTV loans, lower risk business plans, and shorter maturities that give us really great pricing power. And as you can see, the rates have continued to rise. I think a lot of people have expected rates to fall, especially with the short side of the curve falling with the Fed lowering rates. But the long side of the curve has continued to increase. Durations for loans have continued to increase, which just makes it that much more painful for people to be holding on to traditional debt. I think that's where it breaks free for us to be having the Ascent Income Fund, which is a single fund diversified across several different senior loans, invested for short-term bridge scenarios, offering an attractive 11 to 13% net yield to investors with liquidity options as well, because it's not just the yield that's important to investors. It's also having ability to access that capital at the end. And it's in the middle market, right? So we're not chasing after the big Blackstone KKR deals. We're not doing this hard money lending to individuals. It's still professionally managed real estate in the institutional commercial space, but we're doing it in the middle market area, which allows us to get even more pricing power. It's potentially ignored by traditional banks and traditional lenders. It's on asset classes and business plans that might not be well understood by traditional lenders, which allows us to price them that much more attractively, leverage our experience and our team's decades of experience in the middle markets with these types of asset classes, and putting it in an attractive vehicle for individual private investors to get access to. So, I think it's a low minimum, it's an attractive yield, and it's a product, I think, in a fund that's been designed specifically for investors with their concerns in mind. Getting into the actual investment criteria and what we're looking for, I alluded to some of it with bridge scenarios and different types of loans and the LTV, but Marious, what is your team looking for when it comes to the debt opportunity set that we're putting in this fund?
Based on the pricing of our debt, we are looking at value add transitional assets that are either they need a bridge to some level of permanent financing, or they need a bridge through the end of a renovation, something that where we know that we can refinance out of at more conventional sort of debt service coverages and LTVs. The benefit of the environment that we're in today is that there are thousands of opportunities to choose from. And our partnership with Mark Smilichap allows us to sift through, probably one of the richest data sets in the middle market in the country today. As a result, we're able to sort of pick from, an enormous top of the funnel and present investors with some really, really good risk-adjusted returns. We do believe that the biggest asset class we're still seeing opportunity in is multifamily. People, had made sort of investments in low interest rate environments, and they need a bridge, to sort of stabilize or to get to a better LTV scenario. So we're seeing, equity infusions from sponsors into transactions. We're seeing some attractive purchases where sellers have capitulated and realized that, it's no longer worth it for them to hold onto the asset. So we're entering new investment acquisitions at really, really attractive bases. One of our biggest loans was a partnership buyout where the new owner was able to purchase the asset at, almost 50% of the, original basis, making our loan just very, very attractive. And we're seeing thousands of opportunities in that space today.
Yeah, and getting to the diversification, it's currently right now diversified across 4 different property types. As Marious said, multifamily is still the largest one. It's the largest asset class in commercial real estate by far. But we also have some assisted living, hotels, and mixed use has been an area where we've seen a lot of opportunities recently, both on the debt and equity side of the equation. We're diversified across a lot of the East Coast. We've been looking at opportunities on the West Coast and the middle of the country as well, but currently just getting the fund started. We have a lot on the East Coast, but spread across the East Coast, not just concentrated in the Northeast corridor. I think what we're also seeing is opportunities in really tier 1 cities, New York and DC. We're seeing a lot of great opportunities as the market has sort of bottomed. And what Marious said is, with capitulation of sponsors, they're either giving back the keys, you have to refinance at a better rate. And we're getting those opportunities in traditionally priced out areas like New York, but we're getting at really, really great opportunities there. And we've seen excellent returns with no defaults in the portfolio so far and no missed payments to investors in the life of the fund. Most of it is going to be on acquisition or refinance, those bridge scenarios that we like. It's not new construction loans. It's not heavy value add type loans that we're putting in. And of course, all of them are senior loans on the portfolio right now. It's a senior lending portfolio. It's a senior lending fund. And that's what investors have been looking for, something that has the safety of senior debt, low LTVs, giving a cushion on the value of the property, and those consistent monthly payments from the loans that we pay out in a quarterly dividend to investors, which comes with a contractual obligation of debt. So I think it's a really compelling opportunity for investors in the fund, and it's a fairly low minimum to enter, and you can allocate across time. It's an evergreen fund as well, and allows you to add money over time and just compound your wealth. And any distributions can be reinvested in the fund as well.
There's a 1-year lockout, and after which, you can redeem your investment from the fund itself. So making it attractive to give, investors liquidity, after a year, because we understand that liquidity is important to people.
Okay, thank you for the overview. That was fantastic. Now we're going to move to the fun part. Well, it's all fun, but the really fun part is where we get to ask all of our questions. And I think last time I started with Paul. So in the interest of fairness, Chris, we'll just hop right over to you, and you can open up with the first question.
Well, guys, that was a great presentation, and I'm a big fan of debt funds as you outlined in like this market cycle. So I would appreciate if you could walk me through like one loan example, maybe a fairly recent transaction, kind of like who the client was, and then how you found it. And I think from in your PPM, you have like a loan advisory committee, and then how that's approved, and just kind of like walk me through from like the client perspective and how it funnels back up to the fund. I would love to hear that.
We have a small team, but we're partnered with Marcus Millichap. And I know if your audience is familiar with Marcus Millichap, but in the middle market space, they're just, they're the 800-pound gorilla. They do thousands and thousands of transactions a year. So we have our own network of brokers and originators that from around the country showing us opportunities. But in addition to that, it's amplified enormously by the broker network and the origination network in-house at Marcus Millichap. So we're able to sort of say, we like these markets, we like these opportunities. What are you looking at? What's the need? And, how can we be helpful? So that's one way we get opportunities. And then the other way is just like people in the space. Over 10 years, we've developed a fairly robust, following of sponsors looking to tap into middle market debt and middle market equity. And typically the people who are also looking for equity are also the people looking for debt. We have some sponsors where we have been both the lender on one side and then the equity on another, never at the same time, but the need is still the same. The middle market is grossly underserved by, the private markets, and that's where we sort of come in to fill a hole. So as an example, we have 8 deals in the fund currently, and we're looking to, we have a very, very robust pipeline already into 2025, so much so that we're sort of, pushing deals away currently, and we're being highly, highly selective. A good example of a transaction that came to us was a multifamily transaction in Atlanta. This was a transaction where the sponsor himself had committed like a fair bit of equity into the transaction. And, through our relationship with Marcus Millichap, they had reached out and said, are you guys able to transact on an $18 million loan? We said, absolutely, we have the capacity to do that. We were able to underwrite the deal quickly because we had all the information. We didn't have to re-educate ourselves, on the market. We knew Atlanta. But more importantly was Marcus Millichap had with the sponsor, they had all the information ready to go. We were able to sort of download the data room incredibly quickly, get on a plane, fly down to Atlanta, meet the sponsor, identify the risks, identify that the sponsor was committed. The sponsor was willing to put in more equity into the transaction, which was always a good sign because, in this environment, it's very easy for some sponsors to just, throw their hands up, give the keys back and say, I'm tapped out. And then as a result, we got comfortable and we were able to close the transaction, within 40 days, which is fairly fast. Typically, the process for us looks like an investment will come in or an opportunity will come in and we'll be able to screen it. There's a tabletop screen that our investment team consisting of, overall 6 people across both the debt and equity. And we'll utilize, information from our asset management team, which is 6 people deep. And these are all former bankers, investors, private equity, associates. Once it is past the tabletop screen, we will then take it to a mini investment committee, which consists of a smaller panel of in-house associates to say, does it meet this criteria? Are we over allocated in one market versus another? And then subsequently, it will be presented up to the investment committee if it passes that. That whole process, I would say, takes, depending on how much information we have, 12 to 15 days. Once it's, gets in front of the investment committee, there's more information that we need in order to issue a quote sheet, or there's or it's a pass. And usually then that gets processed within 2 days. So we're usually offering quotes if we like the transaction within 10 days of receipt, to 12 days of receipt. Then the hard work starts. Deposits, diligence, ordering third parties. It's a full institutional process by which we're investing, and we're sort of making loan approvals.
Oh, that's a great explanation. Thank you.
Usually I would go to Paul right now, but he's going to get in the weeds, I know, because that's what Paul does. And that's good, Paul. We want that. But I'm going to ask a general question before we dive too deep. This is not a typical debt fund like we have seen, because usually it's either, they're doing first or second mortgages, or they're, loaning to flippers. This is, from the current portfolio, multifamily loans, assisted living facilities, and hotels. So can you talk a little bit about like the example terms, interest rate, length of loan kind of things, especially if we're familiar with multifamily, but when it comes to assisted living and hotels, kind of the purpose, what they're looking for, and just some of the general terms?
We price generally between 450, 500 over, right? And typically we are able to lever anywhere from 40 to 60% of that loan itself to achieve the sort of desired yields in the fund itself. The way it works in multifamily, I'm sure your audience is fairly familiar with, as a lot of residential developers also dabble into multifamily, so they understand the LTVs and everything to that effect. But in the assisted living or hotel loans, or even office, loans that we've done, what we're looking for is, strong underlying credit and a pathway to coverage that allows our loan to be taken out when the loan matures. We're usually sort of terming our loan out anywhere from 18 to 36 months with extension options at times. But, we would like the business plan to be sort of accomplished usually within that window. And depending on the transaction itself, the size of the transaction, we sort of price accordingly and we term out the deal accordingly.
Excellent. And just so everybody knows, you mentioned 450 to 500 over, and that means like 4.5% to 5% over the SOFR rate.
Over SOFR. Yeah, it's a floating rate. Yeah, exactly. Sorry about that.
No. I just want to make sure everyone's on the same page there. That's perfect. So, Paul, now you don't even have to get in the weeds, Paul. I made an assumption, so now you can jump in with your question.
Thanks, Jim. You're starting to get to know me a little too well. It's getting comfortable here. Marious, Daniel, very much appreciate the presentation and certainly buy into the thesis of private debt being a strong position right now in everybody's portfolio, given where we're at in the market cycle. I do want to get into the weeds a little bit, as a matter of fact, and it really starts in the executive summary of the PPM. The organizational structure is a REIT at the top, the equity multiple Ascent Fund, and then it sounds as if, and I just want to make sure I'm understanding this correctly, that each loan is made and held in its own SPV. And then there's leverage utilized through SPV leverage facilities. There was language, quote unquote, BP notes. I kind of want to see how that all flows down from the top as a REIT, and then understand the use of leverage in the fund. And can you talk a little bit about that? And then what are the levered returns versus the unlevered returns?
Sure. So let me talk about this backwards. So let's talk about, the leverage. Daniel has fielded more questions around the REIT than I have at this point, so I'll let him talk about that. So there's a lot of committed funds out there, and what they'll do is they'll find a line lender, whether that's like, a big bank, or these private A-note lenders, and they'll give them a facility across the entire fund, right? And usually if it's a closed-end fund, that's a lot easier for them to understand because there's commitments and everything else. Evergreen funds are a little bit more complicated because, the NAV dips up and down. Closed-ended funds, the NAV just tends to go up, but because of liquidity and everything else in an evergreen fund, it goes up and down. So that ends up being a little bit trickier to do. However, sort of we love that, that thorniness, because that presents us with an opportunity to sort of differentiate ourselves where others can't. And what we do is by providing each loan as an SPV, we're able to sort of have an army of A-note lenders. And those A-note lenders are pricing their money at 200 basis points really tighter than where we are. And we're able to get positive leverage on that. So typically, it allows us to keep a lot of these A-note lenders competitive because they know that we have an army of 7 lenders that we're talking to on every transaction, and that number keeps growing. So, if we talk to a bank like Oak North or Northeast Bank, as some of the banks that we're talking to, we're not handcuffed to, one lender being the only lender that we have to talk to on any one transaction. And that gives us a lot of sort of flexibility. And the way it works is, just to make the math easy, let's say we're doing a $10 million loan, right? And that's that amounts to a 65% LTV on the transaction itself. And we're pricing that at, make it easy again, 500 over. So that's 5% over SOFR. We're able to talk to our A-note lender and get 60% advance on that loan itself. So they're making a 60% loan on a 60% loan. And effectively they're giving, so that's 40%, loan to value on the loan itself. We're borrowing money at 300 over in that scenario, thereby sort of juicing the returns approximately, depending on that leverage, by 4%, 400 basis points. So on an unlevered basis, the sponsor or the developer operator is paying 11%, but the gross yield pre-expenses is around 15.5% approximately, at the fund level. Then there's fund expenses that eat into it, admin, tax, audit, management fees. And that brings the fund level returns anywhere, again, depending on sort of where we're investing, if there's any cash drag, anywhere between 11 and 13%.
Where do you see there might be some risk for LPs with that type of structure?
The one thing that we are hyper focused on, right? I mean, we're focused on the underlying credit of the sponsor and the deal itself. But where we spend a lot of time on is, can the A-note lender in that scenario get hurt? Not that we care about their feelings, obviously. We just don't want them to sort of take over our position in any scenario. Because the fund itself is going to be highly diversified, one of the benefits of a broad-based middle market fund that has, that's going to have a multitude of assets in it. We don't want that one lender to sort of say, because invested across the plethora of the deals, if one deal falls behind on a payment at our level, right, it doesn't affect the overall sort of fund dynamics. What we are really, really concerned about is that the A-note lender is constantly satisfied. So then that deal doesn't ever get put into a position of impairment. So that's where the risk lies in that structure. We are hyper focused on ensuring that all of our deals pay out at a extremely healthy debt service coverage ratio to that A-note lender. We'll take less leverage day in, day out to make sure that that is protected.
I think one other big risk management piece that I've had investors ask me about is, okay, we're pricing to floating, right? It's a fluctuating rate. How do you guarantee, or how do you make sure that you're going to hit those bogeys that you're hitting for yourself? And something that we put in place is we fix those rates for a lot of our borrowers. We'll take fixed leverage on the A-note. We'll have floating with a floor on the borrower. So we're kind of getting upside leverage on the upside, but we're capped on the bottom side. So, we're getting that fixed leverage on the note, which gives us a solid floor of the return. And then if it goes up, then it just leads to more upside potential for the fund.
That's comforting, because I've seen it work the other way, where it's a fixed rate to the borrower and a floating rate to the leverage, and that can create some issues.
You're digging yourself into a hole if you do that. Yeah, exactly.
It can work the opposite way. When rates started coming down and you had a fixed rate, that was attractive. And, there was a time when we thought about the fixed versus floating, because sponsors in this environment like the fixed component. They don't like to know that, that interest component is going up or down. There is some benefit to it, but because we're an evergreen fund, being a fixed, vehicle didn't long-term make sense. That's all.
Excellent. And Daniel, did you want to touch on the REIT part of this?
Yeah, I guess it's the other side of the equation, right? There's the financial engineering piece, which is, very important for this and make sure we do it right. But then there's the structure of the company, the partnership and everything, which also can be a bit convoluted. But I think as we unpack it, might be understandable. So the fund is the LP. So there's EM Ascent LP, which is the fund itself. The fund itself invests into the REIT. The REIT is making the loans to the individual borrowers. So it's essentially like a mortgage REIT. Equity Multiple controls and is the sole investor into that REIT. So there's no external parties. The only investor is going to be the LP, the Ascent Fund, or our GP partner is going to invest into the REIT as well. One of the big advantages of this sort of structure, and why it might be just cleaner instead of doing it just a straight LP fund, is the REIT provides sort of washing of the income. So IRA investors have a benefit where they don't have to deal with potential tax filing for a retirement account because of the leverage. The other side too is that the REIT comes with a tax deduction. So a 20% REIT deduction for most taxable investors. You invest, income comes out. Every $100 that you earn from the fund, in most cases, $80 is reportable to the government, so 20% tax-free. The other pieces of the pie that you might be noticing in the PPM, the BPDN notes, the various structures for the underlying loans. We talked about the REIT, we talked about the LP. So the BPDNs allows us to syndicate those loans individually as well. So we can have multiple investors beyond just the Ascent Fund into each one of the loans. So if we want to syndicate to direct to an investor or direct to our platform, we can also do that. So the BPDN structure allows us to more broadly syndicate those loans down. I think that covers everything else. Marious covered the individual loan SPVs. We put almost anything into an SPV. It's cleaner that way and makes it a lot easier to keep everything accounted for, and then everything rolls up into the REIT, and then everything rolls back into the LP.
Because of the use of leverage, is there any unrelated business income tax UBIT that's triggered?
No, because of the REIT, that's what I'm talking about. It washes that back to the investor, which is a nice consequence.
And so one of the things, we have a platform of over 150,000 people, users on our platform. And one of the things we found is people really like a variety of different sort of options. Some people like to invest into diversified funds, which we love, right? We love them to invest in diversified. But some people really do like to pick. There's kind of no way around that. So as a result, we offer the BPDNs, it's an acronym for Borrow Payment Dependent Note, which is just really an ability for us to sort of offer that single loan to somebody who just wants that credit, that says, you know what, I like this hotel loan in DC. I like the sponsor. I like the story there. I'd like to just invest in that. I don't necessarily want to invest in the rest of the stuff.
Excellent. Chris, you got another question for us?
You had mentioned at some point a lot of your opportunities that come to you don't have traditional business plans that a lot of traditional lenders don't understand and therefore can't underwrite and loan on. Maybe I misunderstood you, but you made a reference like you.
I think that they're in transition.
Like the banks and lenders are in transition?
Well, no. The sponsor and the business plan is in transition itself, right? So consequently, they're looking to us and they're saying, we'll pay a higher cost of capital for this amount of time because a traditional bank is not going to lend, on this business plan where it is today. A good example is, this hotel loan in DC. It was a partnership buyout. It was a heavy, it was going to PIP, which is a property improvement plan, to renovate the asset, install a new restaurant. It was a tired hotel that they needed to renovate. They're willing to sort of pay a little bit more in rate today because on the upside, once the business plan is stabilized, they're going to be able to take out a loan and sort of take out proceeds from the deal itself. So that's one of the benefits of our program. And that's the type of assets that are typically fall into the purview of the loans of the fund itself.
And I think maybe instead of saying what is non-traditional, let's say what is traditional and start there. And traditional would probably be, in most people's eyes, that's a building I like. I can see that it needs a new roof. So I'm going to go get a loan, buy the property, fix it up, and sell it. That's a traditional business plan. Banks can understand that. When you get into things with these partnership buyouts, conversions from office into senior living, when you've got non-traditional sources of collateral, which we've seen on the senior living conversion, which the license and the multiple sources of collateral for that loan made the loan a lot less risky than you might think on its face. That's what I see as non-traditional. It's those things that banks might not have not even that they don't want to do it because they see it as risky, but they don't have the scale or the patience to sort through those sort of situations that we can come in and do with a lot more confidence in the market.
They're underwriting to a very strict box per regulatory constraints. And we're able to sort of, given our experience, see a little bit past that box and understand some of the mitigants to it. So able to price better and see opportunities where others are going to miss them.
I want to switch gears and switch over to compensation and how you guys make your money, which obviously is a big component of this, and it needs to happen. There's an assets under management fee, and then the PPM goes into what's described as incentive allocation amount. And it sounds as if LPs have rights to earnings in the first 3 quarters. And then there's a excess core earnings formula that's attributed to some earnings at a 20% level. Can you just break this down for us in layman's terms so we can understand how that all works?
Yeah, fairly simply, it's a 20 over an 8. The investors have to make an 8% return, first and foremost. Anything above that, the GP, the sponsor, ourselves, equity multiple, right, earns 20% of every dollar above an 8. That's the layman's version.
Just to follow up on that, there's a couple places in the financing fees and in this incentive allocation where it says the GP can waive for any LP at their discretion, or that's for the allocation. For the financing fees, it says the LPs will be entitled to receive a portion of the financing fees at the GP's discretion. So just curious, what is that and which LPs get that? Or is that just something that you might do someday kind of stuff?
It's a little bit of both, right? We have anchor GP investors that are taking sort of GP risk alongside us, and they're entitled to some of the financing fees. But typically, it's really meant for large ticket investors into the fund itself to sort of incentivize them to, if they want to make a large ticket investment. The flip side of that is that some of those large investors are locked up for far longer than the typical LP investor is. So in some cases, so it's not it's just it's a free ride. Those investors are locked up for 2 to 3 years before they can redeem any of their capital, versus our traditional LP investors are locked up for 1 year.
Perfect. Thank you for that. And we are kind of over the allocated time here. So Chris, Paul, do you guys have any final questions that are critical that you want to ask?
Paul asked my last question on the waterfall structure, so I'm great.
Yeah, that was great. Appreciate you guys. Thank you very much.
This was great. We do need to get into the weeds because we're not just going to come on here and ask the easy questions, because most of that is in all the documents, right? So we try to really dig deep, and you guys answered every question with good answers. So we really appreciate that. Thank you for coming on. We're going to jump off and have our LP conference, but thank you for coming on the deal review. We appreciate you.
Great. Thanks, guys. Really appreciate the time.
Thanks, guys.
All right, guys, the GPs, the equity multiple guys have jumped off. That was a great Q&A and a great presentation. So I want to just remind everybody that, we aren't here to make recommendations. We're here to provide additional insights for this opportunity. If you're considering investing, obviously, we strongly recommend you make your own conclusions, do your own due diligence. What we're going to do here is we are going to say, if we had capital, what we think of it. But first, we're going to talk about the deal a little bit. So Chris, Paul, did you see any red flags? Anything that made you think, I'm not sure about this?
No, I didn't see any red flags necessarily. I thought the flow of the business plan or the structure of the business was a little bit confusing. Just going through the PPM, it wasn't something traditional like I've been used to seeing. The compensation structure, I asked about that as well, was a little bit difficult to understand the way it was worded. But then when asked about it, it was clear and concise. Like, it's anything over 80, is a 20% share of profits. Or 8% is a 20% share of profits. That makes total sense.
It makes sense, Paul, but I don't mean to interrupt you, but I didn't see anywhere in the PPM or anything I read an 8% hurdle. So where do they get that 8%? Did you guys see that?
I'd have to go back and look again, but that's not what I have in my notes. So I guess that's worth looking into a little bit more for sure. But those aren't necessarily red flags. I think those are going to be cleared up, and maybe it's in there, maybe it's not. If it's not, then that might be a red flag.
Chris, any red flags?
No red flags, and I agree with everything Paul said. A couple things I'll add on for things I liked is 2 things stood out to me. I like the fact that they're very dialed into like Marcus & Millichap, which is, one of the biggest brokerages, and that's an amazing lead flow for them for their business. So that gives them a unique advantage for seeing opportunities because, brokers are frontline with a lot of these deals and, want to help their client. The second thing is, this is something I always look for in debt funds is just, hey, what's the process? Hey, what is your due diligence process? Now, obviously, we didn't get down to all the nuts and bolts, but he was very clear on, hey, we get the lead flow, we have our team do this tabletop, then we have a subcommittee loan, then the full committee, then the third-party audits, and the on-site due diligence. I like that a lot because that is where, any deal, especially debt funds, either excel or there's a lot of risk on there, because I've seen debt funds, they don't have a tight process or they don't always follow the process. And to me, that's one of the biggest risk factors is, hey, debt is you follow the process. If it checks the boxes, great. If it doesn't, well, then it should probably be a no-go on the deal. So overall, I liked it a lot. And I like the market they're playing in that mid-market. I think it's a great cycle right now.
Yeah, I didn't see any huge red flags either. I think the one thing that I really like about this, and, we talked about this a little bit, but typical debt funds are either doing, home mortgages first or second position, or they're lending to flippers. And this is completely different. They're lending to, basically sponsors, operators, syndicators, the people that we're investing in. And so the one question, though, that I didn't get to ask, there's a couple, but one that we kind of ran out of time. These are essentially bridge loans, right? They're short-term loans that are supposed to get the operator, whoever is taking the loan, to the next part of their business plan, right? And so my question would be, what happens if after 24 or 36 months, they haven't accomplished what they need to accomplish? Meaning, a lot of these operators are in distressed deals and they're thinking interest rates are going to be lower. What happens if that doesn't happen? So does that mean these are going to default? I assume there's extensions they can take up, but do those get more expensive? So that's something that I would have wanted to ask. And while we are off, another thing I would have wanted to ask, but Chris asked, was about the minimum. And just for clarification for the listeners on that, the minimum, if you've never invested with equity multiple before, is $5,000 for your first investment with them. And then if you've invested with them before, then for this particular fund, the minimum is $20,000. So just wanted to make sure that everybody understood that. So I think we touched on it a little bit, but do you guys have any other questions? What other information would you need? And or did you see anything else that you think is just fantastic, like the upsides of this fund?
I'd piggyback on what Chris was talking about as far as due diligence on the actual loans themselves. If they stick to the criteria they've outlined in the PPM, then that's one thing. But getting a loan tape can reassure you that they are. So kind of analyzing each individual loan, what's the LTV on that loan? So I'd want to look at that. I'd want to ask more about liquidity. I know they have a lockup period, but what is their history of being able to redeem capital when someone asks? How long does that typically take? That's a big thing right now with debt funds is like, yeah, they're nice and they can be a good vehicle to deploy some capital into, but eventually you're going to want that capital back out. So how long will it take?
And we might not know because this is a new fund, correct? I mean, it seems like it's pretty new and it's a year lockup, so I don't know if we'll know that yet.
Right. It could be difficult to predict that. But those would be a couple of questions that I'd have. And lastly, I would ask about self-dealing because it sounds as if they're into other asset classes, they're investing in equity, they've been operators in the past, are they using any of the funds in the Ascent Income Fund to fund the capital stack of other deals that they have in their portfolio?
I would definitely check on there, but Marious did make a comment, at least I interpret it, because I was thinking the same thing. He said they're never on both sides of the same deal. But I agree with that was one of the things, and I believe that's what he said. Another question I had, I didn't get to ask, you made me think of this, Jim, is in their PPM, they talk about their eligible loans, which is a criteria of the out loans, versus permitted investments, which would be, I think, ones outside their box. And I was curious to know what their planned ratio would be because everything's eligible loans right now. And I know most debt funds have this kind of wild card, hey, we can do some of these more opportunistic loans or opportunistic things. I'm always curious, hey, what are those and how much percent of the fund could be put into this extraordinary bucket?
It did mention real estate related businesses. So does that mean like a lawn care service or, a roofing company? Would want to know more about that for sure.
Yeah, and it's probably pretty much anything, but that's one of the things where I think talking to the principals gives you some comfort, right? Because they could do anything. That PPM is broad. It allows them to pay certain LPs or emit LPs from, expenses. There's a lot of things that they could do, but part of this whole process is trying to get to know them. So you're like, okay, these guys, they write the broad documents because their attorneys want to make them as broad as possible so they can do anything they want to do. But you got to get to know the operator and get to know the people behind it so you can understand what kind of business person they are and what they're actually going to do, because you can't lock everything up in a PPM, right? There's going to be some leeway.
I think I enjoyed having Marious on there. Man, he is just obviously a brilliant person. And then Daniel, man, he's one of the best educated, communicated, investor relations reps I've encountered. I thought their communication, their staff was top notch, just as impression and dude, yeah, you guys passed the gut check.
They did. And I think it's not very common that you can pass that gut check without sounding salesy, right? They weren't super salesy. They were just a matter of fact. And I think, part of what I'm getting out of these deal reviews is how deep, especially you guys, dig into that PPM and how important that is, because we're always finding something. It's not necessarily a negative thing, but it's something to ask a question about. I did not understand the distributions, right? And Paul asked that question and it made sense. There's some more confirmations we need to do. But overall, anything else you guys would like to say before we say what we would think about investing?
I have one thing. He mentioned that they use leverage. And I think in the past we had a debt fund we did that had leverage. I'm a fan of leverage in debt funds, used smartly. I'm curious your guys' opinion. Do you like leverage in debt funds, or is that a no-go for you?
I wouldn't say it's a no-go for me. I'm in a few funds that use leverage, and I think they're using it prudently. It certainly can be a double-edged sword. What I would want to dig into more if I were investing in this deal or considering investing in this deal is how they're structured, from the REIT level down to the SPV level, and then really looking at the leverage facilities and how they feed into the different LLCs that are associated with that SPV, and who's owed what first. Because really you're in a situation here where they're lending to borrowers and they're taking a senior loan position at, let's say, 65% LTV, but then they're allowed to, Marious was talking about, borrow up to 45 to 65% of the pledged equity in that deal from the borrower. So they're really levering up beyond that 65% LTV. It's more like 80 to 85%. And I'd want to understand who's exactly involved in those LLCs and who's getting paid back before you are as an LP, and kind of have that all drawn out in a diagram to see, okay, here's the equity multiple Ascent Fund REIT at the top, and see how it all flows down. And I don't really have a really good handle on that at this point.
Yeah, I think for me, I don't mind leverage in a debt fund. I actually like it, as Paul said, if it's conservatively used. The thing here was I was watching both of you as he was explaining the REIT structure and then the SPVs and all that stuff, and you guys were both nodding your heads in the affirmative. And if I had a emoji on my face, it would be like question marks all over and shaking my head like, what is happening? Because I was pretty confused by that. When I'm confused nowadays, I'm going to be a lot more cautious, right? Because there were some times when I wasn't sure what I was investing in, maybe in the before times, and those did not work out well. So now we'll transition to, and I think I asked Paul first, I'll ask you, Chris, if you had capital available to invest, would you consider allocating capital to this fund?
Yes, I would. And to kind of just at a very high level, and this is just me kind of speaking, due diligence, always learning. I think he's mentioned to me that $5,000 initial investment, like, hey, if I'm investing a large check or, we're pulling investors' capital together, there is a lot higher level due diligence, right? But when there's opportunities, hey, it all looks good. I'll throw in $5,000 just to really learn the process and see it. Like, I'm happy to pay a few dollars for a night class, right? Would be my equivalent to junior college, or hey, let me just see and learn, low risk, and $5,000, that's in my fund money, part of my portfolio. So from that, I would do it just to get my toe in the waters and really start doing due diligence and get to know them. Because then you see the reports, you see all the documents, then you can really trace back, the loan tape, the organizational chart, like that. That's
a great point. And it's similar to what I think I said, and maybe you said, Chris, on the mortar group one that we did earlier, was if we could take a smaller swing, because we talk to these operators and they're competent, clearly. They know what they're doing, clearly, both this one and the mortar group. And so, yeah, I would take a small swing, but I need a little bit more confidence to take a bigger swing. So I totally agree with that. Paul, what do you think? If you had capital to allocate, what would you consider this one?
Initially, I was going to answer that I need more information. I'm intrigued. I like the thesis. I think that there's going to be a lot of opportunities for them to lend to borrowers that have special situation needs or time horizons that they can fill and provide that bridge, as you called it. So I like that, and I think there's good returns. And assuming that everything checks out as far as additional due diligence, I would consider investing a bigger amount. But back to your points, I think 5,000 is a number where you can say, hey, you know what? Part of my due diligence is understanding how these guys communicate, what the process is to be onboarded, how's their portal, all that kind of thing, right? So it's if you can get that experience firsthand for just sort of dipping your toes in the water, there's value there. So I think for a small swing, as you called it, Jim, it might make sense to do that. For a bigger chunk of money, I think I would need to do a little bit more due diligence, though.
Yeah, and I think for me, I was going to say, until Chris kind of reminded me that I could get in for $5,000, I would say I would not allocate capital to this deal because there's parts of it I still don't understand. And I don't know how many times I could talk to these guys, and they know what they're doing. I don't know that I would understand how the SPV loans to itself and then gets loans from other people and then rolls up to the REIT and then rolls down to the LPs. It is mystifying to me, and I've tried to hold to it, that I'm not going to invest in something that I don't understand the structure, especially when you're talking about different entities dealing with each other. Because, I've invested $104,000 in certain things that there's entities, and some of them are, not working together very well. And so, yeah, $5,000 to kind of test it out, I would consider it. But no doubt I have confidence in these guys. They know what they're doing, and they're a quality operation. It's just that I, right now, don't have a very good understanding of how the structure works, and that makes me uncomfortable. And I'll give you guys a chance for last comments, but I just want to remind anyone watching or listening that these are not recommendations. Everyone needs to do their own due diligence. These are just, if I had money in my pocket, would I consider investing? That's how we're answering this. We're not making recommendations. We're not financial advisors or anything like that. So, Paul, I'll give you the last thoughts on this deal.
Yeah, that's it. We pretty much covered it. I mean, the structure is a little bit more complicated than I'm used to, too. I don't have a full grasp on it. I think these guys are fully capable, but that's it. That's what I want to dig into a little bit more, is understand that structure. And even if I didn't understand that structure, I might throw $5,000 at it just to test it out.
Yeah, I've got no additional comments other than what I said. And hey, intrigues me to throw a few bucks there potentially in deals like this just to learn. And so I think it's really important everyone kind of figures out, hey, what's their due diligence process? And part of me is like, hey, I'm happy to pay for a little bit of education as well along the way. A little bit, not a lot, hopefully.
Exactly. Well, Paul, Chris, thank you as always for being here and providing your fantastic experience knowledge to us. And that wraps up this deal review episode. A big thank you to Daniel and Marious for presenting their deal, and to my fellow LP panelists, Paul and Chris, for sharing their expertise. We hope this episode gave you valuable insights into what experienced limited partners look for in a syndication deal, the questions they ask, and the factors they consider before making an investment decision. Thanks for tuning in, and as always, happy investing.